Hello and good morning, folks. The world financial markets are acting up on daily basis, and we through Almus Market Mornings look to bring you all these updates regular basis. This is Shikhar Garg, and thank you so much for joining in to Almus Market Mornings. And as we talk about acting up, what volatile moves are we seeing in the pound as a currency? I mean, 200 pips of movement up and down within hours. That's quite significant and interesting. South Korean central bank also was seen raising rates, while Indian markets, as usual, were showing their resilient ways of, acting in the markets. The Indian yields, forward premiums, the overnight interest rates, everything were seen coming down slightly yesterday. So, JK, what's your thinking? What's happening around? Can you just guide us?
Hey, good morning. Yes, there's extreme volatility continuing in all the markets. In fact, I'm looking at the bond market, which has become much more active, two-way action seen, and a lot of cues are being taken from what's happening in the UK money market. As we know, UK announced limited QE program after their fiasco of mini budget, and then it is ending on 14th of October. Yesterday, announcement was made that there will be no extension to this, and so there was a lot of selling. Subsequently, of course, they actually added the inflation-linked bonds also for their purchases, up to that limit of 65 billion pound that they have announced. That actually gave some relief to certain segments. Again, yields dropped and the selling rallied. But overall, markets have seen, or rather used any rally in the bonds to sell. And that is actually spilled over into other markets as well. US 10-year yield almost touched 4% once again, and 2-year yield trades at the highs. And German yields are also at the highs seen in 2011. So it's all driven from a bond market as of now. And the stocks, of course, the MSCI Global Index of Stocks hit its lowest level in almost 2 years, losing almost 40% from February 21 peak. But even at these levels, we are not seeing any significant buying emerging, barring some profit taking from shorters. Of course, we did see a bit of a fall, bit of a pause in the fall yesterday. Not that it indicates any end to the downtrend. The only reason being the market awaits the release of inflation data from US, PPI today and CPI tomorrow, as well as earnings report from major banks on Friday. It could be time for them to just consolidate. Adding to markets concerns, IMF on Tuesday warned of a disorderly repricing in the market, saying global financial stability risks have actually increased. The fresh COVID restrictions in China was again of not help. I think regions of Shanghai and Shenzhen have been, again put under some restrictions. So the global recession fears are just only intensifying, and it's not coming off. Also on the IMF, they have predicted a global growth to slow to 2.7% next year. That's 0.2% lower than the July forecast. And it anticipates that 2023 will feel like a recession for millions around the world. And more than a third of the global economy will see 2 consecutive quarters of negative growth. The United States, Europe, and China will continue to slow as per the report. And they also say that laid out 3 major events currently hindering growth: Russia's invasion of Ukraine, cost of living crisis, and China's economic slowdown. So together, they actually paint a very volatile period economically. And also, you just read it along with JP Morgan's prediction of a very severe recession in the next year. So it's not a good climate for investors to be taking any position in the risk assets at all. IMF also, downgraded its forecast of growth on India, bringing it down to 6.8%. That's 0.6% lower than the downgrade, rather the forecast they made in July. They are reflecting on a weaker than expected outturn in the second quarter, as well as a more subdued external demand as the reasons for downgrading India's growth. Yes, on the currencies, despite global central banks, protesting a steep fall in their currency, it's all been confined to verbal protests so far, barring one intervention from Japan last month. But otherwise, market seems to be pushing them further down. Attraction of higher yields in the US, coupled with relatively better growth and safe haven demand for dollar, is not going away in a hurry, and it would need a big drop in inflation or peace talks to take some concrete shape for us to see a meaningful recovery in the currencies. And meanwhile, sterling, as you mentioned, Shikhar, had a big rally of 1.5% yesterday. And then gave up all those gains later as the bond market went into a tailspin again. And we are now at much lower than yesterday morning levels at 1.0950. Euro has been holding steady, mainly because the action is more in Euro GBP cross, and Japanese yen has broken into a new low of 146.30. Again, we are hearing only verbal statements from Japan. No real action has been seen. Emerging market, or rather, the commodity currencies are still under pressure because of increasing statements from various quarters about the recession fears in the global economy. On the rupee, thanks to RBI's renewed efforts of selling consistently at 82.40, the spot rate has remained steady in the very narrow range. There is an expectation that once the RBI moves out, again, we will move towards 83 levels. Of course, market is also awaiting the CPI data from India today. Expectations there are for 7.3% to be hit from a level of 7% that was seen last month. Once again, the food inflation is going to be a big contributor. The higher inflation, we will have WPI also tomorrow, and industrial production data for August on a year-on-year basis will also be published today, and that is also expected to show some deceleration. And of course, industrial production data is always a very volatile series, and this time it is also affected because of the base effect being higher last year. So all in all, I think the markets are looking forward to key numbers this week, but very unlikely that any of them is going to change the the course of the market for us. And in rupee, of course, no change in the trend is seen. It may be once again a cause, or rather a pause, I would say. And we have, just to give you a perspective, from 22nd September, post FOMC, we have seen a move of more than 3% in the USD, and that's a lot of movement. So the consolidation is quite justified, but does not indicate that there's a change in the trend, actually. Thank you.
Okay, so folks, that's what we hear. There's not much of change in trend that we expect on the currency front. But yes, there has been a lot of warnings being released by the IMF on the financial stability of the global markets, as well as the growth concerns about the global markets. I mean, there are reports stating 2 quarters of negative growth, or a recessionary phase coming in. So, folks, there's a lot of things that we are going ahead into, and just on the shorter term frame, we have our Indian inflation and the industrial production numbers being released that can put in some cues and action into the currency. So folks, let's await what sort of a data release that we have. Meanwhile, thank you so much for listening, and we shall come up again with our another update on the macros as well as the financial markets that we see are happening in around. So thank you so much for listening. That's it for today, folks.